$14,600. That's roughly the size of the tax deduction a lot of widows quietly lose the moment their 2-year filing window closes. Not because they did anything wrong, but because nobody told them the window existed in the first place. 1 year, you're filing your taxes almost exactly the way you always did, at the same rates you're used to. The next year, with the exact same income, the exact same house, the exact same life, your tax bill jumps by $2,000, $3,000, sometimes $4,000. Nothing about your finances changed. Your filing status did, and almost nobody explains that in advance. Here's the sentence I want you to remember before anything else in this video. The IRS gives a widow a 2-year grace period after her husband's death where she can still file her taxes almost like she's married, using the same generous tax brackets and the same larger standard deduction a married couple gets. Then, without a letter, without a reminder, without anyone at the IRS reaching out to say, your window is closing, that grace period simply ends. If you don't know it's coming, you file the next year's return the same way you always have, and you overpay, sometimes by a lot. Or worse, you get flagged for filing under a status you no longer qualify for. I want to walk you through exactly how this window works, why it exists, and exactly what to watch for so it never catches you off guard. First, I'll explain the filing status itself, what it's actually called, what it does for your tax bill, and why it only lasts 2 years. Second, I'll show you a real comparison. I'll call her Margaret, so you can see the actual dollar difference between filing it right and filing it by habit. Third, I'll give you the exact steps to take before your next tax season, including one alternative status that can soften the landing if you have a dependent at home. And stick with me to the end because there's a second, smaller trap buried in this one. A mistake with retirement account withdrawals that shows up in the very same tax return. The filing status nobody explains. When your husband passes away, the IRS doesn't force you to switch tax categories right away. For the tax year he died, you can still file a joint return with him, the same as if he were alive, assuming you don't remarry before the year ends. That part, most widows already understand because it's usually handled with help from whoever prepared the final return. What almost nobody explains is what happens next. For the 2 tax years immediately following the year of his death, if you have a dependent child living with you, you may qualify for a status called Qualifying Surviving Spouse. It sounds like a small technical label, but what it actually does is let you keep using the same tax brackets and the same standard deduction that married couples filing jointly get, even though you're now filing as a widow. That's a meaningfully lower tax bill than filing as single, because single filers hit higher tax rates at lower income levels, and the standard deduction for single filers is roughly half of what a joint return allows. Here's the part that catches people off guard. That status only lasts for 2 tax years after the year your husband died. Year 3, unless you qualify for a different status like head of household, you're moved into filing as single. And single comes with a noticeably higher tax rate on the same income and a standard deduction that's cut nearly in half. Nobody sends a letter. Nothing on your return from the prior year flags it. The software you use to file, if you use the same one every year, doesn't necessarily warn you that your eligibility window has closed. You simply select a filing status the way you did last year. Or worse, the software defaults you into whatever it thinks applies. And if it's wrong, you either overpay without realizing it, or you file under a status you no longer qualify for, which can trigger a correction letter from the IRS months later. This is sometimes called the widow's tax penalty in financial planning circles, not because the IRS is punishing anyone on purpose, but because the jump between the last year of favorable treatment and the first year of single filing status can feel exactly like a penalty when it lands on your return without warning. It helps to understand why the 2-year limit exists at all, because it isn't arbitrary. The idea behind qualifying surviving spouse status is to give a widow time to adjust her finances gradually, rather than absorbing the full cost of a filing status change in the same year she's also absorbing the loss of her husband. 2 years is meant to be a bridge, not a permanent arrangement. The problem isn't the 2-year limit itself. It's that the bridge simply ends on schedule, on a date determined by when your husband passed, not by whether you happen to be ready for it. A death in January and a death in November both start the same 2-year clock, even though the emotional and financial adjustment period feels completely different depending on when in the year it happened. This is also why so many widows get blindsided by the switch, specifically in year 3. Years 1 and 2 often feel financially manageable precisely because the tax treatment hasn't changed yet. The grief is fresh, but the numbers on the return still look familiar. Year 3 is when both things happen at once. Enough time has passed that life has started to feel more settled, and that's exactly when the tax bill quietly jumps, arriving right as everything else finally seems to be leveling out. Margaret's return. Let me put real numbers next to this so you can see exactly where the money goes. Margaret's husband passed away 3 years before I sat down with her. For the 2 years after his death, she qualified for qualifying surviving spouse status because her youngest grandson, whom she had legal custody of, lived with her as her dependent. Her tax preparer handled it correctly both years, and her tax bill stayed close to what it had been when her husband was alive. A joint-style standard deduction, joint-style tax brackets, roughly $9,200 owed on her combined pension and investment income. Those 2 years, Margaret didn't think about her taxes much at all. And that was by design. She'd used the same preparer for over a decade, someone who understood her situation and quietly handled the filing status correctly without making a production of it. From where Margaret sat, nothing about tax season felt different from when her husband was alive. That consistency, ironically, is part of what made the 3rd year land so hard. There had been no gradual warning sign, no smaller increase the year before to soften the jump. It went from feeling completely unchanged to feeling like a completely different tax bill in a single filing season. The 3rd year, her grandson turned 18 and aged out of qualifying as a dependent for that particular status the same year her 2-year window closed anyway. 2 separate things happened at once, and neither one was flagged by her usual tax software. She filed the way she always had, using the same program, clicking through the same screens, and the software defaulted her into single filing status without asking a single clarifying question about her situation. Her income hadn't changed by $1. Her tax bill came out to just over $13,400, a jump of more than $4,200 from the year before, all from the filing status switching underneath her without a warning. Now here's what the smarter version of that same year looks like. If Margaret's tax preparer had caught the transition in advance, 2 things could have softened the landing. First, confirming whether any other dependent in her life, not just her grandson, might have let her qualify for head of household status instead of single. A step down from qualifying surviving spouse, but still meaningfully better than single, with a higher standard deduction and more favorable brackets. Second, timing certain income, like a retirement account withdrawal she'd been planning anyway, into her final qualifying surviving spouse year instead of the following one, capturing it at the lower rate before the window closed. Between those 2 adjustments, her actual increase could have been closer to $1,800 instead of $4,200. The exact same income, the exact same life circumstances, just handled with the calendar in mind instead of on autopilot. That's the entire lesson in one sentence. The tax bill doesn't jump because your life changed. It jumps because the calendar changed, and nobody told you to look at it. What to do before your next tax season. Step 1. Count which tax year your husband passed away, and mark your calendar for exactly 2 years after that. That's your qualifying surviving spouse window, and it closes automatically whether or not you're using it correctly. Step 2. If you have a dependent child or grandchild living with you, confirm with a tax professional whether you qualify for qualifying surviving spouse in years 1 and 2, and whether you might qualify for head of household starting in year 3, since that status doesn't require the same 2-year limit and can still offer meaningfully better rates than filing single. Step 3. In the final year your favorable status applies, sit down with the tax preparer before December, not in April when you're filing, and ask specifically whether any planned income, retirement withdrawals, the sale of an asset, a Roth conversion, should be timed into that final year instead of pushed into the next one, when your rates will be less favorable. Those 3 steps handle the filing status transition, but I promised you a second trap, and this one hides inside the exact same return. Trap 2. The retirement withdrawal timing mistake. Here's what catches widows, even when they've got their filing status sorted correctly. Required minimum distributions and other retirement account withdrawals get taxed as ordinary income, which means they land directly inside whatever tax brackets apply to your current filing status. In the years when you're still filing as qualifying surviving spouse, a withdrawal of a given size might sit comfortably in a lower bracket. The exact same withdrawal, made 1 year later under single filing status, can push into into a noticeably higher bracket because single brackets compress faster than joint-style brackets do. Widows who've managed their retirement withdrawals a certain way for years, taking roughly the same amount out annually without much thought, sometimes don't realize that the tax cost of that same habitual withdrawal changes underneath them the moment their filing status shifts. It's not that the withdrawal itself was a mistake, it's that the timing, relative to the 2-year window, wasn't considered at all. This trap is especially easy to miss because retirement account withdrawals often feel automatic, almost like they're on autopilot, separate from the rest of your tax picture. Many widows set up a standing withdrawal amount years earlier, sometimes back when their husband was still alive and helping manage the accounts, and that number simply continues unchanged year after year, unless something forces a review. A filing status change is exactly the kind of thing that should force that review, but because it happens quietly in the background of your tax return, rather than showing up as a letter or a phone call, it rarely does. The fix mirrors the filing status fix. Before your qualifying surviving spouse window closes, sit down and ask specifically whether pulling slightly more from retirement accounts in that final favorable year and slightly less the following year changes your total tax bill across both years combined. Sometimes it does, meaningfully. Sometimes your situation doesn't benefit from adjusting at all. The only way to know is to ask the question with the calendar in front of you, rather than filing on autopilot and finding out in April. Before you go, I want to be straightforward about something here. Tax rules, brackets, and deduction amounts adjust from year to year, and your specific numbers depend on your income, your dependents, and your state on top of federal rules. Everything I've walked through here is general education about how the filing status transition works, not a substitute for sitting down with a CPA or enrolled agent who can run your actual numbers. If you're inside that 2-year window right now, that conversation is worth having well before tax season starts, not during it. But here's what doesn't change, no matter what your specific numbers are. This window exists. It closes automatically, and nothing about the process is designed to remind you when it does. Knowing the calendar is half the battle. The other half is asking your tax preparer by name whether qualifying surviving spouse, head of household, or single is the status that actually applies to you this year, instead of assuming last year's answer still holds. If this helped you, do 3 things. Like this video so it reaches more widows before their own window closes quietly. Subscribe, because next week I'm walking through the beneficiary form trap, the one that can send money to the wrong person even when your will says otherwise. And in the comments, tell me what year your husband passed, and I'll do my best to help you figure out roughly where your own window stands. I read every comment, and if there's a specific state tax question underneath your situation, ask it there and I'll point you toward the right resource. You've carried enough on your own this year. Let the calendar work for you instead of catching you by surprise.